Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into the financial world of Allegion PLC, a company that keeps our world secure. And let's just say their latest report has some interesting things to reveal about how they are doing. Think of it as looking behind the curtain after a dazzling security show. Before we get into the nitty-gritty, if you like cutting through the corporate jargon to get the real story, make sure you smash that subscribe button. And hey, we have a great community over on Discord, link below, where we break down these filings even further. Come join the conversation. So, Allegion PLC has just dropped its annual report, the Form 10K for the fiscal year that ended on the 31st of December 2025. This is their big yearly checkup, a comprehensive look at their business, their risks, and of course, their financials. It tells us how they've performed and what they're up against for the future. Allegion is known for security products and solutions aiming to keep people and their belongings safe. They've got brands like CISA, Interflex, LCN, Schlage, Simons Voss, and Von Duprin. Think doors, locks, and all sorts of access control systems. In 2025, they pulled in net revenues of a whopping $4,067.3 million and made an operating income of $859.5 million. That means after paying for everything it cost to run the business, they were left with a substantial amount of profit. Let's talk about how much money they actually brought in. For the year ending the 31st of December 2025, their net revenues climbed by 7.8% compared to the previous year. That's an increase of about $295.1 million. What drove this growth? Well, they mentioned much of it came from better pricing, meaning they were able to charge more for their products, and from acquisitions. They also saw a small boost from currency exchange rates, meaning their international earnings translated to more dollars. Now, how much did it cost them to make all those products? Their cost of goods sold as a percentage of net revenues actually went down slightly in 2025 to 54.8% from 55.8% in 2024. This is good news. It means for every dollar of sales, they were spending a little less on making the products. They attribute this to a better product mix, meaning they sold more profitable items, and favorable currency movements. Plus, their productivity improvements helped offset rising costs like materials and labor. It seems they're getting smarter and more efficient in how they produce their goods. But running a global company isn't cheap. Their selling and administrative expenses, which includes things like marketing, salaries for non-production staff, and general overhead, climbed a bit as a percentage of net revenues in 2025, going from 23.5% to 24.1%. This increase was mainly due to inflation, meaning their costs for things like salaries and marketing went up more than they could improve efficiency in those areas. They also had higher costs related to restructurings, integrations, and acquisitions they made. So while they were selling more, a bit more of that money was going towards running the company itself. When you put all that together, their operating income grew significantly. In 2025, they made $859.5 million, up from $780.7 million in 2024. That's an increase of about $78.8 million. Even better, their operating margin, which shows how much profit they make from their core business operations, improved to 21.1% from 20.7%. Indicating that despite some cost pressures, they are effectively managing their operations to generate profit. Let's look at the cash. Net cash provided by operating activities for 2025 was $783.8 million, a solid increase from $675.0 million in 2024. This is a really healthy number. It shows the company is generating plenty of cash from its day-to-day business. This cash is crucial for them to invest in new products, manage their operations, and pay dividends to shareholders. When it comes to investing, Allegion used a lot more cash in 2025 than in 2024. Net cash used in investing activities jumped from $228.4 million to $685.5 million. What's behind this big jump? Mostly acquisitions. They bought a lot of new companies in 2025, which requires a lot of cash up front. They also increased their capital expenditures, which means they spent more on things like equipment and facilities to support their growth. Financing activities shows how they manage their debt and equity. In 2025, they used $266.7 million in financing activities, which was less than the $394.5 million they used in 2024. This decrease was mainly because they bought back fewer shares of their own stock. They also made some debt repayments and increased their dividend payments to shareholders. Looking at their debt, it remained pretty stable. At the end of 2025, their total debt was $1,980.1 million, down slightly from $1,999.5 million at the end of 2024. Most of their debt, about 90%, has a fixed interest rate, which is good. This means they are not as exposed if interest rates jump up. They also have a revolving credit facility that can provide them with up to $1 billion in case they need extra cash. Let's break down their business segments. The Allegion Americas segment, covering North America, saw net revenues grow by 6.9% in 2025. This growth was driven by better pricing, higher volumes, and some new acquisitions. Their electronic security products, a key area for them, saw a low double-digit increase in sales. Their operating margin in this segment improved to a strong 27.9%. This part of the business seems to be doing quite well, benefiting from pricing power and growing demand for electronic security. The Allegion International segment, mainly Europe, Asia, and Oceania, did even better in terms of percentage growth. Net revenues grew by 11.7% in 2025. This was primarily thanks to recent acquisitions that boosted their sales along with favorable currency exchange rates and improved pricing. However, their volume, meaning the actual number of products sold, actually decreased slightly. Their operating margin here is much lower, at 9.0%, but it did improve from 8.7%. This segment is showing growth largely through buying other companies, but core volume sales are a bit of a concern. Now, let's talk about goodwill. This number represents the value of their acquisitions that is more than the fair value of the actual assets they bought. It's essentially the premium they paid for things like brand reputation, customer relationships, and expected synergies in 2025. Their total goodwill jumped significantly from $1,489.4 million to $1,912.4 million. This big increase is directly tied to all the acquisitions they made this year. The Allegion Americas segment saw a notable rise in goodwill, while the international segment's goodwill also increased considerably, again, all due to buying other businesses. It is important to remember that goodwill itself doesn't generate cash, but it reflects the company's strategy of growth through acquisition. This ties into their intangible assets, which are things like patents and trademarks that don't have a physical form, but still add value. Their total intangible assets also grew substantially, from $569.0 million in 2024 to $826.0 million in 2025. Again, this is mainly due to the recent acquisitions, where they've identified and valued these important intangible elements of the bought companies. They amortize these assets over their useful lives, and the expense for this amortization also increased. Allegion's tax situation is quite complex, being an international company. For 2025, their effective tax rate was 16.2%, up from 14.5% in 2024. This increase was mainly because they earned more income in countries with higher tax rates and had some unfavorable changes related to uncertain tax positions and income tax credits. This shows how international operations can really impact the bottom line through taxes. Finally, let's look at the ultimate profit number. Their net earnings attributable to Allegion plc ordinary shareholders for 2025 were $643.8 million. This is a healthy increase from $597.5 million in 2024. This means the company is becoming more profitable, which is always a good sign for investors. Diluted net earnings per ordinary share also saw a nice jump from $6.82 in 2024 to $7.44 in 2025. Now, no company is without risk, and Allegion is no different. Their report highlights a significant number of potential risks. Global macroeconomic factors are a big one, meaning if the world economy stumbles, their sales could be hit hard. Increased prices and inflation are also a major concern, as they struggle to pass these rising costs onto customers. Geopolitical uncertainty, things like trade wars, tariffs, and international conflicts, could also disrupt their business. Competition is fierce, and they worry about new technological developments changing the game. And then there are the ever-present risks of cybersecurity breaches and supply chain disruptions, which have become a constant challenge for many global companies. Speaking of cybersecurity, Allegion takes this very seriously. They have a chief information security officer, and their entire board of directors oversees their cybersecurity strategy. They invest in training and work with external experts to test their systems. They recognize that AI is making cyber attacks more sophisticated, and they are adapting to those new threats. While they say they haven't faced any material impacts from cyber incidents, it is clear they are paying close attention to this evolving threat landscape. One of the most critical areas they have to get right is revenue recognition, especially with their diverse range of products and services. They have to be super careful about when they actually count the money they've earned. For product sales, it's usually when the goods are shipped. For services and software, it's when the service is performed or the software is delivered. They have to estimate things like discounts and rebates, and to raise always a risk they get these estimates wrong. This is why the auditors spent a lot of time verifying their revenue numbers, looking at orders, invoices, and shipping documents to make sure everything was accounted for correctly. Now, looking at these numbers more broadly, Allegion seems to be navigating a complex global environment pretty successfully. Their strategy of growth through acquisition is clearly visible, as reflected in the spike in goodwill and intangible assets. They are increasing their revenues, maintaining their profit margins, and generating good cash from operations. However, there are definitely some areas to watch. Their increasing reliance on acquisitions means they need to integrate these new businesses smoothly and ensure they deliver on their promised value. The rise in selling and administrative expenses due to inflation is a persistent challenge, and they need to keep a close eye on that. Risks like global economic slowdowns, geopolitical instability, and cybersecurity threats remain significant potential headwinds. In conclusion, Allegion is a robust company that appears to be executing its growth strategy effectively, particularly through acquisitions and a focus on electronic security. They are profitable and generate strong cash flow, but they face substantial risks that require constant vigilance. What is your take on Allegion's financial health and their strategy moving forward? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more breakdowns of SEC filings. We also have that growing Discord community linked in the description, so come hang out with us. Thanks for watching, and we'll see you in the next one.